All right, y'all. I think I got this. So without delay, again, I think this is so important that I just had to figure this out to get to let you inside the minds and the discussions around index universal life policies and really how it can help you um, protect your money, insure your money, and ensure that your money outlives you simply because you know 50 is the new 30. That's what they say. And 60 is the new 40. So if you have, especially if your family has that longevity gene, how do you protect your money to ensure that it outlives you? So without further delay, we're gonna try this for the third time. Third time is always a charm, and yes, looks like we got it up there. So let's start it. There
Yeah.
in the code, some people say, "How do you hide information from people?"
Yeah.
You put it in a book.
Yeah.
And it's not a loophole. It's
No,
not
it's
something
not.
that's
It's
going
No,
not a
away.
it's not.
loophole.
It's
It's not.
something that's been there for over 100 years.
Yep.
Yeah,
Yeah.
and most agents aren't taught how what they have,
Right.
right? They aren't taught the product itself. So it's not a scam because we're heavily regulated,
Yeah.
regulated.
I tell people all the time that there's three enemies to our wealth, technically four. First is taxes, inflation, and market volatility.
Right.
But the last thing is what you don't know.
Right.
What you don't know can really hurt your
Right.
wealth.
Yeah.
And so I wanna go with and talk a little bit more about the rates of return that we're looking at. Again, I have to keep going back to the fact that we're in some really volatile times right now, and some people might think, oh well, how much money can I actually earn inside of a life insurance policy?
Right.
So, anyone is one want to speak to that?
I'll comment on that. And you think about rates of return. So just a simple thing. Maybe people have heard of the rule of 72. So that's about, if you take the number 72 and divide it by your rate of return, that's about how long it'll take your money to double. So 6%, your money would double every 12 years. At 10%, your money would double every 7.2 years. So think about this in terms, too, of things that we buy in our buying power. Does a hamburger or a car or rent or, how long, is that going to double in price in 10 years, 20 years, 15 years? So when it comes to rates of return, the money that we earn needs to be able to keep up with inflation and
Greg, do you remember when
and
eggs used
taxes.
to be 89 cents?
Yeah, that was a few years ago.
I'm old enough. When I was a kid, you could get gas for a gallon, for 25
We
cents
were
a gallon.
fussing when it was 69 cents, and I had a Fleetwood Cadillac.
Yeah. So it's relative to, but with rates of return, so where can you go and put your money that you can outpace taxes and inflation? So, we're talking 5%, 6%, 10%, 12%. Yeah, there's things out there and high risk things, where you maybe might earn more or hit a home run, but you need that balance between risk and reward.
Yeah.
And so,
Yeah.
and when you learn about this compound interest feature, Einstein said that compound interest has been credited, at least that compound interest is the eighth wonder of the world. Well, the next phase of that is compound. If that's the eighth wonder of the world, then what is tax-free compound interest?
Right.
That the compounding can never be interrupted.
Exactly.
We might call that a miracle. That's
Right.
what some people say. So it is
Right.
just really incredible. So when you think about, and we were talking about locking in your gains. So think of an indexed account like an IUL, where you're going up a staircase
That's the
Right.
way I see
or
it
an
too.
escalator. You'll go up, but you never go down.
Never go
Yeah.
down.
So what happens with the market, or maybe you're in cryptocurrency, or maybe you're in an alternative investment? It's a little bit of a roller coaster.
Right,
Okay,
right.
I could ride roller coasters when I was a kid and a teenager. Right now, merry-go-rounds, my idea of a throw ride. And then if your money's all in like lazy money, that's in CDs, money market, you're not going to keep up with tax and inflation.
Yeah.
That's
Yeah.
right.
You're going broke slowly.
You're- yeah.
You
Right.
need
Yeah.
a little
Actually
money there.
losing money.
So that balance is what's so important when it comes to rates of return. And
Yeah.
what do we see? Maybe somebody else can comment. What do you see with IULs?
I don't know. I would say as far as structuring it, let's start there where if it's structured properly, your financial professional is keeping an eye on how to allocate and move your allocations around so that you get the best opportunity at growth, right? So that it's optimized. If they just put it in place and just kind of forget about it
Right.
and never update it and do your reviews and give you your options on watching the market and seeing where you're going to get the best returns, then it can kind of fall flat.
Right.
So you got to keep an eye on it, just like you would the stock portfolio. You want to make sure that you understand the allocations and how to really maximize your returns within the account. So having a good professional on your side is going to be
You
key.
mentioned something that's very important, right? The educational piece. The client has to have skin in the game, right?
Right.
And I say on my podcast all the time. Number one, be curious. Number two, own your financial life.
Yeah.
Do not give it away to anybody. If an agent sold you a policy and you haven't looked at it and you don't even know where the agent is,
Yeah.
then you lost money. I only have to look at your policy.
Yeah.
You're losing money.
Yeah.
Absolutely.
That brings up a very good. So, IUL has been in the hot seat. Okay, over the past couple of weeks.
Now I'm gonna stop it here just a little bit. She's about to discuss the Cal Bush situation with his IUL and his lawyer. He and his wife are suing Pac Life, basically for its policy not being set up correctly, and it had a lot to do with number one, his knowledge of how to set it up and his funding the policy itself and not tracking it through the years, and also his agent maybe not looking, um, basically looking after his own financial his financial gain. So let's hear the discussion.
Because there's a person of influence who is basically in litigation over his IUL and saying that IUL is a scam. Anybody want to speak to that?
I would say that most of the time people just purchase the IUL and they don't really participate with the advisor. That you need to sit down with the advisor on annual review to make sure that you're on track, right? But if you don't do that, that's a missing piece. And you don't know where you're gonna go in the future, how much money you're gonna have in your policy. And a lot of people don't really follow up with the advisor. They think that, wow, this policy is so easy, I can do everything for myself. And it takes a little manage. No, it's not. You really need the advisor to help you keep you on track and stay in touch with the advisor. I think that's the most important thing.
So
I think the advisors need to stay in touch with them. I think there's a lot of lazy advisors. That's
Oh.
my thought.
Yeah,
That
I would
just
say
don't
that both.
follow,
there's a
yeah,
lot who
that's
don't
true.
know what they don't know.
Right,
And
exactly.
speaking to that case, it was a
Exactly.
Kyle Bush case. Kyle Bush and his wife filed suit, and they're in a very opportunistic law firm who they chase insurance companies is what they do. They're trying to sue a 160-year-old financial institution that's one of the backbones of the economy in the world, Pac Life. And so it wasn't that vehicle. Kyle Bush drives NASCARs. Those are high performance cars, and you wouldn't go put a Toyota Corolla engine in it. And he doesn't go and fill that up at the pump at 7-Eleven and swipe his
Right.
card. They go into that pit and they got a pit crew, and they're out of there in like 15 seconds changing tires and filling it up with gas. So he's got experts working with him, and that's where that thing, from what we understand, fell short. It's just because somebody had an insurance license. Probably a lot of these policies, because IULs have a lot of moving parts,
Yes.
there aren't experts in them, and that's where we're at, and that's why think it's so important for people to seek and find somebody like us. We're certified IUL professionals. We've been trained by the top people in the industry,
Yeah.
and we're probably the 1% of the 1% in the country who can do this.
For sure.
Yeah.
Just
Yeah.
because somebody has just because I have a piano in my in my living room, I cannot play Chopin or Beethoven or anything like that. My granddaughters taught me row, row, row your boat, but I forgot how to do that. So
That's funny.
it's because I haven't practiced.
It's a good point.
So good.
Really good
So
point.
good. You guys, listen, what is something that you all want the audience to know about insurance, specifically around IUL, that you think that they don't know?
I think insurance is the most powerful vehicle, financial vehicle that's out there. It's misunderstood. People only think of it as a death benefit. And it has a very bad reputation, I'll say, within certain communities because I remember the policy man, right?
The insurance lady.
And my aunties and grandmom would leave the little envelope, and then when they pass, there was no insurance. They barely could bury them because
Yeah.
it was the wrong tool. Insurance is a tool. Find the right tool. Be curious about what you don't know. Ask the professional.
Yep.
That's good.
And to that point, I one thing that I left out as far as having a tool, you want to make sure you have the correct tool, but it takes a professional or someone who understands how to use that tool to fit it into a bigger strategy. I often say it's like having a scalpel. All right, you have a scalpel. A scalpel in the hands of Jack the Ripper, Ripple, Ripper is different than a scalpel in the hands of a very skilled surgeon. So it's a tool, but you want to have a strategy around that. Being in the military, we learned about weapon systems and how to place it within the higher operations. Right? You have to look at your entire uh, structure, right? What are your assets? And then how do you put that tool in place to to complement your strategy, to complement your goals? And Miss Vicky, my homegirl sitting next to me, I think she's gonna bring that home in the next point.
Well, go ahead, Vicky.
Go ahead.
Well, that
Yeah.
made me think, Carla, about the analogy that Doug and Imran used. Were you thinking about that too, Greg?
Baking soda.
Well, baking soda, yes.
Yeah.
And also, what about the clubs in the swing?
Yes.
Yeah.
Yes.
Right? Okay, so, and Imran says this a lot. Like, would you want, and I'm not a golfer, so I'm going to embarrass myself, but I do know Tiger Woods.
Okay.
So if they ask me, do you want Tiger Woods' swing or do you want his clubs? I would say, I'd really like to have his swing, right? So even with the tool being important, which you're right, it is important.
Yeah.
But the most important part is, do you know how to swing the club
Right.
Yeah.
for it to perform correctly?
And as far as a product, another analogy is people think about insurance and life insurance as something you protect yourself with, something you have to die to use. But so it's not what it is, but what it does. For example, what are some of the things you can do with baking soda?
Get rid of
Brush your
odors.
teeth.
Get rid of odor, brush your teeth, clean up
I
the
put it on
corrosion.
an anthill.
on a
It
battery.
gets rid of ant
Oh,
hill.
I didn't know that. When we were kids, we got a bee sting or a wasp sting. My mom would make a little paste in her
Paste,
neighborhood
right.
and put it on there,
Yep.
take the sting out. And oh yeah, you can bake with it too. So, so serious long-term money goes to one of three homes. It goes to the market, it goes to real estate, it goes to insurance. And a lot of people don't realize insurance is one. And think about, we all know the story of the three little pigs, right? So think about 2008, 2009. You know, they had the House of Straw, the House of Sticks, and the House of Bricks. And in 2009, the big bad wolf howled. Okay,
Oh yeah.
he blew
Amen.
the
Yeah.
houses down.
Yes.
And what happened to 401ks? They became 201ks. The
Yeah.
market dropped. What happened to real estate values? You know, dropped 40, 50, 60% in some areas. What happened to people who had money in insurance products like this? Absolutely nothing.
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 No insurance company went out of business. They rarely do. Over 800 banks or over 1,000 banks, you know, had to be closed down. And so it's one of the safest havens. You know, these companies, these top companies, like we mentioned, Pac Life, but there's many others. They've been around for over 100 years.
Yeah.
If they were not legitimate and they went out of business, we need to worry about some other things.
And
Like,
it's
Yeah.
interesting. I want to go to you, Ken, on giving what you think people should know. But 401ks is a new concept, a fairly new concept.
Yeah.
It was 1978, I believe
Yeah.
it came out. But Ken, I want to hear what you have to say in that.
Yeah, I would say that by to Greg, what Greg just said. So a lot of time people think about life insurance, and automatically they shut their mind down. They don't do further research because they think that life insurance. I know everything about it already, right? But you want to think it in terms of never lose money in the market, compound interest, and tax free. Imagine those two factors together. What can you do about it? If you have those two features in your life, right? What are you gonna do?
Right.
It's gonna change your life a lot, right? But you didn't think about it because they call it a life insurance.
That's good.
Yeah.
Brendan, what about you?
I would add to you guys by saying that as a financial advisor, right? I hold my Series 7 and 66 licenses. And so a lot of times when we're talking to people about their money, they just think traditional, like stocks, bonds, mutual funds. So to bring up a conversation and introduce an index universal life, it's like this new concept to them. So part of our job, probably one of the hardest things is really educating them on it and overcoming some of those old ideas of, oh, it's just life insurance, like you guys are saying. And then helping them to see all the value and all the benefits that go into it. And then how it can layer in to their big picture, if not be the staple of it.
Yeah.
And so that for me has just been, kind of a game changer and eye opener for my clients because a lot of times, they'll go and talk to their CPA or they'll talk to someone else or a friend. And they're like, they've probably never even heard of it or they're just not properly educated. So get the education, really understand it and how it can really work for you
Yeah. And
in your unique situation,
in your unique situation.
Yeah.
Exactly. I want to share. I want to share this. I believe that life insurance is the foundation. Has to be the foundation of our financial portfolio. And I can kind of prove that in several different ways. But one, when we think about life insurance, and I'll get to the IUL eventually, but when we talk about life insurance, because none of us are discrediting just regular life insurance, right? If something were to happen to you, or someone in your family, say you got into a car accident or something like that, you didn't have any disability, you didn't have any type of insurance that would pay you against loss of income or anything like that, what do you have to do now? You have to start liquidating assets, right? Okay. Well, did you buy those assets to liquidate them so it could pay for your health care? No. So again, life insurance being the foundation, but then also being able to put our kids through school. We use life insurance to be able to help put our kids through school. A lot of times people are getting 529s, and 529s, they're limited on what they can do, but
Yeah.
these life insurance contracts aren't as rigid as a 529 is. And then also, let's talk about asset optimization. We can use life insurance for asset optimization. We talk about all the time, and I want to get into this conversation. I want us to end with this conversation about asset optimization, but so many people are putting their money in places and driving down debt instead of actually building up wealth. And
Yeah.
so, how anyone want to speak on how you use life insurance for asset optimization?
I'll go. So, lots of people use the Dave Ramsey theories and methods that he has taught about paying down that debt. Absolutely 100% pay down that debt. But if you are just an average person trying to make a living and grow a little assets, what is going to happen if you don't have some assets put away because you've spent all of this trying to pay down your debt? You can be debt free, but you don't have something to pull from, then you're going to be back in debt because you don't have that savings there to pull from when something happens, when you need a new roof, your kid breaks their arm, or whatever happens. So that's just a tiny, tiny at the bottom level. Example, and we can talk about a higher example there. But if just at the baseline, I'm not saying not get out of debt. I'm saying that you need to do both. You need to have a plan for both.
Yeah.
Well,
And the great thing about asset optimization. Excuse my southern tongue. Sometimes I can't get around those words. But if you think about the growth in an IUL, taking some of your cash value, taking that loan, which is 5%, and then putting it into another investment or property that's gonna net you, say, 12%, right? So that money is constantly working, and you still have your cash value, right?
Yeah.
Can I say, I want to hear what you have to say, Greg, on that. But one thing I want to say is people think of life insurance as death insurance.
Yeah.
It's not just death insurance. That's a great thing. I know my mother passed away when I was 4. Okay, I've had deaths in my family. Everybody has had that, right? But what about life insurance? Using it for your life,
Yeah.
living while you're living. If your advisor can't tell you how to set it up properly, and those questions, by the way, want to put a plug in here, Shaky.
Okay.
That's a perfect plug.
If you can't get to someone you trust, then start here.
Yeah.
Start here. And there are questions in here that if your advisor can't answer, then you might want to look somewhere else.
Yeah.
Because if you're certified, you can answer those questions. And so, Greg,
Well, I think when it comes to debt, think about this. I mean, if you were in a river or a stream and the current is coming at you at 18 or 20 miles an hour or 28 miles an hour, and you're swimming upstream at 6 miles per hour, you're not making any progress, right? You're going back. So when it comes to unsecured, high interest rate debt, absolutely you need to get rid of that first. That's a financial foundation.
Yep.
You need to have an emergency fund. An IUL, by the way, eventually can be used as an emergency fund. So you need some basic, you need some foundation, and then it's think about saving for the future. Now there's other debt that's secured. That it's a little bit different conversation. And how you effectively manage that is a wide thing. So. And debt's not sexy. Nobody wakes up, I want another bill to pay. Okay. And some people sleep better at night, and some people are save them from themselves by absolutely having no debt, and it's not a bad way to go. But that's, I think, with us, we can look at everybody's individual situation, what best fits them, and all that. But definitely that's not good. But you think about businesses. You think about a bank.
Yeah.
What's a bank's biggest asset is their liabilities. We put money in a bank, and they owe us 0.1%, 1%, 2%, 3%. And does that bank keep that money there?
No.
Well, it's not sitting in the vault. No, they're loaning it out for car loans, credit card loans, mortgages, business loans. They're making money. They're putting it to work. So that's one of the cool things about a laser fund is you can actually use it as your own bank where you can have safe, positive leverage, if you will, and then it's a myriad of other things. So if you want to learn more, get in contact with us and reach out to us, and we'll
sure.
teach you.
I asked that question because so my husband and I we paid off our house in 3 years, and we high-fived each other. We did the cabbage patch, we did everything, right? And then we waited for someone to give us a cookie. Nobody came. Nobody gave us a cookie, no trophy, nothing. Okay. But what we did get was we got a higher tax bill because of the fact that, we got rid of our partner in taxes because the IRS loves debt.
Yeah.
Okay. But also, what I realized was that all of my money was trapped into four walls, not moving. And so, what's the rate of return on equity?
None.
Zero.
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 Your house is
Zero.
Yeah.
So there's so many people that they pound their chest and I have a $500,000 worth of equity inside my house, but it's money doing nothing.
Well, I think that's the miseducation. That's where we come in, where we're helping them to educate them on these ideas of
Right.
how they can optimize their assets, right? All these underperforming assets that they have, the old school way of thinking about, well, we consider it old school, right? Of 401ks and IRAs, right? But yeah, I mean, optimizing assets when I meet people and they have their money scattered in all these different pockets of money that they don't even know what it's getting. They don't even know what the rate of return is or how much they're paying in fees.
Yeah.
And then we come along, right? And we're able to help them, educate them and
together.
piece it all together
Yeah.
and then consolidate and then maximize their returns in an index universal life. Get the big death benefit. Instantly, their estate has just grown overnight. That
Exactly.
you know what I mean, and then you have all the cash value in it. That's great. So it really is. What do we call it? The Swiss Army knife.
It is. Really is.
Yeah.
Yeah.
And so someone said, well, what about all of the insurance you're going to pay, all the interest you're going to pay if you string it along for 30 years? And I'm thinking, think about how much interest you're going to make.
Right.
So I did the illustration. So we put in $52,000 every year for 3 years, okay, to pay off this house.
Oh.
I did an illustration for an IUL, very conservative rates. I did it for very conservative rates. After 30 years, I would have earned 736,000 in interest, and I would have also paid off the house.
Yep.
Yes.
Yep.
Do you think I care?
And then
The amount of interest I would have ended up having to pay was, I think it was like 275,000. I don't care about paying 275,000 if I'm going to get back 700.
700.
Exactly.
And not only would you add more money because of that compounding effect, but you could, in essence, had a paid out. You could go take that money and pay off your house, or you could have it where you're in the position at any time to pay off that house and you have
Yep.
liquidity.
Right.
So, dollars trapped under a rooftop, it's tough. How do you get them out? You got to borrow them, or you got to sell the house. And eventually, in our lives, or at the end of our lives, that money's usually going to come out of there somewhere
Yeah.
and go somewhere. So,
Oh, by the way, the market for that house could change. And now you don't have the equity in the house.
You don't have the same amount
yeah,
of
you're in
equity.
Pacific Palisades in California, your house burned down, and it was worth $6 million, and now you can't get it rebuilt, and and you got a lot that's worth $1 million and didn't have insurance.
Right.
Right.
Where's that equity gone?
Right. Exactly.
This conversation is getting so good, and I'm getting to wrap it up.
Our time is
Things
up.
out there. It's been fun. Y'all.
Yeah, it is.
This
We have to
has
do
been
it
good.
more often.
We should. We
do
should.
it more often, but you guys, we just allow.
Well, that was our discussion, and we had a good time. And by the way, I don't understand why I was holding my hand. I'm gonna have to work on my on camera presence there because excuse me, because it needs help. A little blurry. Come on, get me. All right, I guess that's the best it's gonna do. But um, you know, that was our discussion. Those points that were made um, is a reason why we're so passionate about, preparing people for the next phase. Preparing people for the next phase in life because no one told us, all, no one showed us how to grow older and prepare for our leisure years or the years where we want to do what we want to do. um, do you know your risk tolerance, right? um, in the description of this video we have color of money risk analysis. And as you get older and as you start to plan for the next phase of your life, and I do resist using retirement because uh in farm terms, they put animals, they retire animals and they put them out to pasture. Our brains need stimulation. So, and we all have something that we want to do, a goal in mind, a mission in mind. We have to have a mission in mind. This is my mission. After the military, I've chosen this as my mission, a mission to to learn about finance and to distribute that information to the public, information that I feel they can benefit from it. So in the description of this video is a link to color money risk analysis. Take it, learn, start planning for that next phase. Learn where your risk analysis, where your risk factor is, and compare that to where you are now. And that way, you can begin to plan and adjust your plan where you feel is needed. But that's all for today. Third time is a charm for this video, and I hope you benefit from this because as I do these podcasts, my goal is to reach the bring value and to reach as many people as possible. Um, so hey, enjoy your Saturday, and let's get ready for Christmas, man. This is awesome time of year. Take care, and good luck to you.